I know we all have bank accounts. So what we can do is that we separate it. So you can have an account solely for your personal stuff and then an account solely for the business, so that when you're having your bank reconciliation, there's no mix up of the items. Other than that, when the bank statement is made up of both your personal expenses and then the business expenses or operations, it will be messed up because in your cash account, you have not recorded all those personal expenses in there. So it will make the reconciliation quite difficult. I believe at this point in time, we've now realized the importance of bookkeeping and why we must ensure that we are always having good bookkeeping procedures in our organization. So today we are going to learn about accounting methods, how we can account for our revenues, how we can account for our income, and how we can account for expenses. In other words, someone will be asking, when should I account for my revenue? When should I account for expenses? Is it when I receive cash or when the transaction occurs? So today we are learning about accounting methods. It's quite a brief topic. So today I don't think our meeting will be very, very long. But please feel free. If there are any questions, kindly let me know so that I can pause and then answer. Probably not about today's lesson, but maybe prior to the other lessons or lectures that we've had. If there are any questions, you should kindly let me know so that we can move on. And I also believe that we are all on our assignments. Tomorrow, Friday, is the day of submission. Okay, I'm not going to, it's not like I'm going to mark you and then it's going to affect the certificate. No, it's just for me to know that you are picking up or you really understand what is happening here. So even if there's any other extra help I can give to you based on what you presented, I'll be able to do so. But if the assignment is not done and probably there are any challenges you are facing, I already know. Sometimes I may think I'm doing the right thing, but you wouldn't know until it's corrected or someone actually sees it and then corrects you. So that's just by the way. I'm willing to help everyone. So if there are any issues, you can let me know. And please, let's try to finish the assignment. I'll give another one tomorrow after the class. Okay, so as I usually do, I'm going to share my screen with you. And then I'm going to go through the accounting methods. When should we recognize our revenues? When should we recognize all our expenses? Okay, it's very important that we know so that we don't mix up what we do. Today we are recognizing revenues based on the cash you receive. Also, we are recognizing the revenue based on the transaction. As an enterprise or as a startup, as a business, revenues and expenses. So if you're picking one of the methods, know that, okay, this is the method I'm picking. But today I'm going to learn about all the methods. I'm going to learn about their characteristics. And then we now decide the best one that suits your organization. Sometimes too, you can start with a particular method, and as the business grows or expands, then we change the accounting method. So I'm going to see the various methods that we can use for our business. Okay, so I'm going to share my screen with you like I usually do so that we can move on. All right. I believe we can all see. Can someone please respond so that I know that we are all here?
Yes, I'm here.
Okay. All right. Thank you very much.
Oh, I'm not finished.
Someone raised his hand. I wanted to. Okay, someone. Okay, let me share the screen again. All right. So accounting methods. Accounting methods. What's an accounting method? After learning everything about bookkeeping, after learning all the procedures and everything, we need to decide on a particular method we are going to use to recognize expenses and revenue in our accounts. We can't use two methods. We go for one. But then as time goes on, as the business develops or as the business grows, we can actually change the method we are using. Okay. So when we say accounting methods, what do we mean? Accounting methods refer to a set of rules that decides when a business's revenue and expenses are recognized in its book of accounts. Basically, what are we trying to say over here? We are just trying to say that the accounting method that we are going to look at, or the ones that are going to decide to use, it refers to how, as a business, when we can recognize our revenue and when we can recognize our expenses. So many businesses or organizations recognize their revenues differently. Okay, so as I said, we are all different startups, so it depends on how we all have different ways of going about our things, right? So today we are going to learn about the methods in which we can know when to recognize our revenues and when to recognize our expenses. Do we recognize our revenues when we receive cash, or we only recognize revenues when the transaction has occurred? Because sometimes we do sell on credit to our customers, or sometimes we render the service and then we are paid later on. Sometimes we receive the money in installments. So there are so many ways in which we can receive our revenue, or we can even spend. Sometimes, let's say if you are paying your rent, you are not even paying in full. You pay it probably on a monthly basis, or you pay maybe the first year you pay part payment, the second year you pay another payment. So there are so many ways by which we receive revenue or even make our expenses. But the question is that, when should I recognize these revenues in my books? When should I recognize these expenses in my book? Do I recognize it when cash goes, only when cash goes out, or I recognize my revenue expenses when the transaction occurs? So that's basically the accounting methods. So we have two main types of accounting methods. Two main types of accounting methods: accrual basis accounting. We have the cash basis accounting and the accrual based accounting. So I'm going to take them one after the other. Let's look at what the cash basis is about and what the accrual basis is about. At the end of this lecture, we should be able to decide on one particular method you're going to go with. Yes. All right. So when we say cash accounting, what do we mean? With cash basis accounting method, it is the method applied when a business recognizes revenue only when cash is received and recognizes expenses only when cash is paid. So for instance, let's say I have a startup and maybe I have products I sell. When I'm using the cash-based accounting, what it means is that I only recognize revenue when I receive cash. So it means that someone can come to my shop or can come to my office, I'll render a service, I'll sell a product, but until I've received cash, I'm not recognizing it in my books. So it means that all sales on credits you don't recognize it as revenue in your books. You probably go and put it down somewhere and you know that, okay, these people are owing me. But when we go to your books, we can't find out that, okay, so these people are owing you. I hope you all understand. So when you're dealing with the cash basis, cash comes in, cash goes out. So as and when you receive cash, you recognize it. So in your revenue account, let's say when you open your ledger account and it goes to revenue, all the documentations there, all the transactions listed in our ledger accounts are only referring to cash that has been received. So if in a month we've sold on credit, we've not received any, we've not recorded any cash, we've not received cash yet, so we've not received any revenue. That's what it means with the cash accounting. Because you are only recognizing revenue when you receive cash. And you only recognize expense when cash goes out. Okay, so when you also because cash, you don't recognize that as an expense. You go and write to somebody, yes, I'm owing someone, but in your books, and we go to your accounts and go to your books, we can't find that expense there because to you not money has not. You recognize it in January. You bought items from a supplier. You couldn't pay in January, but you're able to pay in March. when we go to your books in January, it means that we don't have any record of the transaction. Meanwhile, the transaction occurred in January. You got the goods in January, but in your books, it's not recorded because to you, cash hasn't left your company yet, so it's not an expense yet. But then when we go to March, that's after 2 months. When you go and pay, that's when you record it. So in March, we can get the transaction in there, but then in January, when you receive the goods, it's not there. So I have an example here. For example, a painter completed a job on December 30th, 2019. Failed, the owner inspects it on. The painter reports those cash earnings on his 2020 report. So this means that a painter completed the work in December 2019, but he didn't receive any money. And because the painter is using a cash basis accounting, he doesn't record that transaction because he has not received money yet. So in January 10th, when the owner of probably the building comes to inspect the paint, is okay, you've done a good job. All right, it means that I'm satisfied with the work. I can now pay you. Then the painter records the cash as earned in what? January 10th. Meanwhile, the project was done in when? 30th December. But because he didn't receive cash at that time, it is not recorded in his revenue account. So at the end of the month, either at the end of December or even at the end of the year 2019, we will not see this kind of transaction in the painter's book. But meanwhile, he has done a job and he has to receive money. But because he hasn't received cash, he has not recorded the transaction. So until the painter receives cash, that is when he goes to record it. I believe at this point we all understand the cash basis now.
Yes, please.
All right. So we are saying that normally for the cash basis, it is smaller companies that usually adopt this kind of method. So small companies that haven't formally incorporated yet, maybe you have your own business somewhere, you have not really incorporated it, and there is a side job you are doing. So most of these small companies, that's what they do. So when they receive money, they all right, sorry about that. I think the internet was messing up again. So I think I can continue now. Sorry about that. Okay, so as I was saying, revenues are reported when cash is received. Also, receivables are not recorded as assets. Someone asked, what are receivables? As I've always been saying, receivables are the money owed us. So if a client comes to you and the person probably sells on and buys goods on credit and all those things, they are all receivables because you are yet to receive them, and you classify them as when people are owing you. That money they are owing you is yours, so they are assets. Okay, so those receivables are assets. But then the cash basis account because you've not received cash. you don't even record a transaction. You just give the goods to your client or your customer on a credit basis. Okay, maybe on a credit basis, you give the goods or the product to your customer. It is not recorded because you've not received cash. Because with this kind of accounting, you need to receive cash before you recognize revenue. Okay, so we don't have any receivables or anything. They are not recorded as assets. And also, payables are not reported as liabilities. Okay, because payables, let's say money that we owe people, we can owe rent, we can even owe our staff salary, we can owe some expenses, some people we can owe, and these are all liabilities. But under the cash basis, because money hasn't left our coffers, money hasn't left the company, we don't record them as liabilities. So there's nothing like liabilities with cash accounting. We will record it when we receive money from them. So there's nothing like payables or liabilities with cash accounting. No one owe People owe you though, but then you don't record it. You only record it when they pay, when you receive your money. Right. Expenses are reported when cash is paid. So anytime you incur expenses, the moment you pay those expenses with cash, then you can record them, then you can report them. But if you incur any expenses and you don't pay it outrightly, or you don't issue cash to pay at that particular moment, you don't report that you spent or if you incurred any expense. So we are saying that at the end of the day, in recording our net income, Shall, do you have something to say? All right.
No, no, please. Sorry.
Okay. Don't worry, it's fine. Okay, so we are saying that at the end of the month, you are calculating your net income, and we know our net income, all our revenues and sales that we have received, less our expenses. That should give us our net income. Our net income for the period is based on the cash receipt and cash payments rather than the revenues earned and then the expenses incurred. So let's use these examples. In January, I sold goods to a client. I've not received money yet. And I've also made some payments. And I've also bought some goods. I've not made the payment yet. Okay. So it means that at the end of January, when I'm calculating my net income, the goods I sold to that client wouldn't be part, wouldn't be counted as my cash receipt because I've not received cash in that regard. And also with regards to my expenses, because as I'm owing someone, or as I've incurred an expense I haven't paid. Maybe you've got some supplies from a supplier. You haven't paid the supplier. Okay, these are expenses that you've incurred. But because with cash basis, money hasn't left, you have not made a direct payment yet to the person you owe. It is not classified as an expense. So with our net income, it is only going to focus on monies we received and then monies that went out. Okay, so it doesn't give a true picture of what has actually gone on in there within a month or within a period of time. So assuming that in January or in a month, all your sales are on credit basis and you've given your customers 2 months to pay, doesn't mean that in January you're not going to record any cash receipt. Yes, because based on this accounting, you've not received cash yet. So you are going to take it as you've not received cash for that particular month. Meanwhile, the transaction has occurred and you've not recorded it because you're using this kind of accounting method to recognize your expense or recognize your revenue. So that's all about the cash basis. Now let's move on to the accrual basis. Accrual basis. We said that we have two methods of accounting for our revenues and then our expenses. Now with the accrual basis, it is the opposite of the cash basis. It recognizes revenue when it is earned and expenses when incurred. This means that income and expenses are recognized in the books of accounts once a transaction occurs. Transactions does not only mean movement of cash. So, as I rightly said previously, once we understand the cash basis, it is the opposite. The opposite of cash basis is the accrual basis. For accrual basis, whether we receive cash or not, whether we paid or not, once that transaction has occurred, we need to recognize it. So all credit sales are recognized as revenues within that particular period of time. All expenses that we've incurred, whether we pay for those expenses or not, all those transactions are incurred. We are not limited to the fact that money hasn't left the company or we've received money. So with accrual accounting, whether you receive money or not, once a transaction has occurred to show that, okay, there's a potential of me receiving money or not, then that transaction is recorded. So with accrual basis, we are saying that it is usually required for publicly held entities and any organization that wants to have its financial statements audited. So normally corporations and publicly held entities use this kind of accounting. Okay. And then we are also saying that with this kind of accounting, it is theoretically correct, but then it requires a greater knowledge of accounting. That's why I said, because with this kind of accounting, you're not only dealing with cash. Whether you received cash or not, once a transaction has occurred, you need to recognize it. So if you are not really conversant with the basis of accounting, it might be difficult for you to use the accrual basis because probably you are not recording all your transactions. That's when you receive and that's when you get it. It will be difficult for you to use the accrual basis. But because I'm saying that accrual basis, you use it when we receive cash or not. We use it when a transaction occurs. So if you go and get supplies from a supplier, once this transaction has occurred between you and a supplier, you need to come and record it. Even if you've not paid, it has to be recorded. If someone comes, you render a service in January and you are paid in March. In January, when you render the service, because a transaction has occurred, you need to recognize this transaction in January. You don't wait till March before when you receive the money before you record before you record this transaction. No, it is recorded when the transaction occurs. Okay, so we have an example here. The cash accounting, we use an example of a painter. For the accrual basis, we are using an example of a carpenter who uses accrual accounting records. Okay, so let's say the carpenter completed his job in December 2019. In December 2019, the carpenter will record a transaction. Okay, so he's going to record it as revenue because he has rendered a service. So he's going to get money for it. He's going to be paid for it. So he recognizes it. He's going to receive money for that particular service that he rendered. So for him, he's going to record it in his books. But he doesn't wait till when he receives the money before he does it. So that is it. So in his books, he goes to credit his revenue and then he goes to debit his client. So his client is now owing him. Yes, so his client becomes a receivable in January. So in February, he will record it as a receivable yet to receive, like as money is yet to receive. That's with accrual. But then if he was using cash basis, he will not record anything. He will wait until March when he's paid, then he records that particular transaction. I believe we all get it to this point. Now let's look at the characteristics of the accrual basis. As I said, it is the opposite of the cash basis. It's the opposite of the cash basis. So with the cash basis, we learned that revenues are reported when cash is received. No. But with the accrual basis, we receive revenue. Revenues are reported or revenues are recorded when they are earned. So for the carpenter, he earned the revenue in January because that's when he completed his service. Okay, so he's going to record or going to report that revenue in January because he's using the accrual accounting. Secondly, receivables are reported as assets when they are earned. So when the carpenter rendered the service in January, he wasn't paid. So he's going to record that as a receivable, and that receivable is going to be an asset because it's due him. He owns that money due him. So when the client pays, then he will just credit the supplier then he will probably debit his cash. But then he will definitely record it when it happens. He doesn't wait until he receives cash. Also, payables are reported as liabilities when they are incurred. So when you owe rent, when you owe your staff, in January you've not yet paid your staff, it's a liability for you, so you record it. You don't say that because you've not paid them yet, you're not going to record anything. No, with accrual accounting, even though you haven't paid the expenses yet, you need to record it. So that becomes a payable to you. Means there is something you are owing. So it reminds you that okay, so you are owing, and these payables become liabilities for you. All right. The net income is based on revenues earned and expenses incurred. So as I was saying, at the end of the month, when we are calculating for our net income, it's going to be all the revenues we've earned, whether we received cash or not, and all the expenses we have incurred, whether we've made cash payments or not. That's our net income. So our financial statement is more complete since the reporting of assets and liabilities best reflects circumstances. So this kind of accounting is known as the best form of recognizing our revenues and our expenses, because we don't wait till we receive cash. Okay, it gives a true picture of what we actually owe and what is owed us. Because if you're using the cash basis, you don't have any records of receivable, you don't have records of liabilities. You are using it as and when. But with the accruals, it lets you know that okay, at the end of this period, these people owe me. These are the receivables I'm yet to receive. At the end of this period, these are the expenses I need to pay. These are the liabilities I need to pay, because these are the people that I owe. Okay, so the accrual accounting gives you reflects gives you a clear picture of what's actually happening. But the cash basis is really limited. It is when cash is received and when cash goes out. So let's note this. The accrual accounting is most preferred as the method of accounting to be used by a business. Cash accounting, on the other hand, is least preferred because it doesn't give a true picture of what is happening. In January, you might have done so many services, but have rendered lots of services, but because you don't receive cash yet, you don't record any revenues, and that is wrong because it's not showing you a clear picture of what you have done. We are saying that with accrual, once the transaction is done, you need to record it, and that gives you a clear picture of the money that you have received at the end of the month and the money that you are yet to receive at the end of the month. And even it gives you a breakdown of all the liabilities that you are also yet to pay. So let's look at this chart. We already know bookkeeping, and the accrual and then the cash accounting can be referred to as bookkeeping methods or accounting methods. That is how we can recognize our revenues and how we can recognize our expenses. Okay, so we have something we call the matching principle in accounting. We have something called the matching principle in accounting. So with the matching principle, we are saying that all expenses must be matched in the same accounting period as the revenues they helped us to earn. So in a particular period, when we need to match every expense to the revenue that we earn in a period. So if we are in the month of January, all expenses must be matched to the revenues. If we don't apply, so we are saying that the so you are saying that for the cash accounting, it doesn't use this particular matching concept. No, it doesn't match the expenses to the revenue. No, it is actually dealing with when I receive cash and when cash goes out. Yes, but with the accrual method, it's able to match every expense with the revenue because we record a transaction when it's as and when it's okay as it occurs, sorry, not when you receive cash or not. So this is just a summary. With the accrual accounting, revenue records are recorded when revenue is earned. So it records revenue when revenue is earned, whether you receive cash or not. Once you have rendered the service, once you have sold that goods, once you've sold that product, you need to record it as revenue in your books because you're definitely going to receive money for it. And then also, once you incur expenses, whether you pay for it now or you pay for it tomorrow, you need to record it as an expense. Okay. But then with the cash accounting, it only records revenue when you receive the cash, and with the expenses when you incur it. There's another table here. That's accounting methods. You have two, the cash basis and then the accrual basis. And then it's talking about when we recognize revenue and expenses. For the cash basis, at the time of cash payment, that is when it is recognized. But then with the accrual, at the time of sale confirmation. So when a client walks up to you and agrees with you that, okay, let's go into this contract, render the following services to me and I'll pay you. The moment the sale is confirmed, the moment there's an agreement that you're going to render these services to your client, then it's confirmed. It's a revenue. You've earned it. Okay. But then with the cash basis, no. It depends on the time you receive it. So you record it when you receive it and not when there's a sale confirmation. So today's class has been very, very, very brief. So that's it's about today. Today we just learned about the methods of accounting. We just learned about the methods of accounting, the cash basis and accrual. So I want you to take time now, reflect on the kind of business that you do. I don't know the kind of business that you do. You know the kind of business that you do. So sit down and reflect. Okay, analyze the method right now that is being practiced by you. So first of all, make two analysis or make two. Okay, you are going to make an analysis and you make a decision. So there are two activities involved. So the first one is that from the time you started business, analyze the method of accounting that is being practiced by your business. Are you using cash accounting or are you using accrual basis? Do you record cash when you only receive it? Do you record revenue only when you receive cash, or you record revenue when it is earned, when the time of sale is confirmed? Now, after analyzing your business and after analyzing the method of accounting that you use, you now decide, okay, based on what I have learned, the characteristics of both accounting methods, which one do I think is going to suit my business? And we all know that as we have, even though our businesses might be small, we all have visions of expanding our business. So the earlier we adapt the best method, the better. So if we are not using the accrual method yet, and we are using only the cash basis, we can give it a try. For this month, we can say, okay, for the next 3 months, let me try the accrual methods and see how it goes. Then as you perfect in that, it helps you so that when the business grows and then it becomes incorporated, okay, and right now your accounts need to be audited, it won't be difficult for you because you have records of every single transaction that's occurred. But if you're using cash accounting and your business is incorporated and auditors are coming around, it will be difficult for you because your statements will not be giving a clear or true picture. There are no receivables, there are no liabilities, and it wouldn't give you a clear picture of your financial position. We can't tell as it stands now what the position of your business is. But if you're able to sit down and analyze, and okay, I need to include or I need to use the accrual basis, then at the end of the month, we can get a true reflection of what actually went on in the business. Other than that, the end of the month will come. And you might have incurred a lot of expenses, but we didn't know. So let's say there are so many things that you bought. Maybe you bought electricity, or maybe the electricity you probably might not have paid at that moment. Okay, so you are owing. Right? There are so many expenses that you have incurred, but because cash might not have left the company, it's not recorded. So at the end of the month, you incurred a few expenses. That's because that's the money that you used in paying, the money that went out. Okay, But if at the end of the month you're using the cash basis, okay, and then you've incurred a lot of expenses, and we all know that the cash basis expenses are recorded when cash goes out, and you have not yet paid for these expenses yet. It's going to give you a wrong picture of your net income. You would think you've made a lot of money, but no, that's not the case, because your net income might look very big. Meanwhile, that's not a true picture. You might actually be owing, and the expense might be a lot. But if you use the accrual basis, it gives you a true picture as that when you are putting up your reports together. So if in January you are looking at all your expenses, whether you paid or not, you can be able to, okay, every month, after taking all these expenses out, this is the money I'm left with. But if it's not done that way, they are not recorded, and you are waiting for money to go out first, then making money. At the same time, you think you're not making money because of the way we record our transactions. So now let's analyze our business very well. And now let's adapt the best method. The accruals might be difficult for a start. Maybe might not really have in-depth knowledge of what you are, of accounting, of the kind of things you are doing, or the kind of accounting details that's required. But it is best that, so I'll urge everyone, I'll throw a challenge to everyone here, that let's start from the month of April to, let's say, May. For the next 3 months, if we are not using the accrual method, let's challenge ourselves to use the accrual method. Let's challenge ourselves to use the accrual method, and then see the difference between our net incomes for when we use the accrual method and when we use the cash basis. We realize that the cash basis will give us very huge profits, will give us lumpy profits, and then the accruals might give us a minimal profit because we record every expense as and when the transaction occurs. So please, that's for today. Any question on what we have done today? Is there any question? Is there any question? Today's class was
I
very,
mean,
very good.
yeah,
Today's
I
class has
mean, I
been
understand.
okay.
Everything.
So okay, thank you very much. So that's it for today. So let's go back and then let's analyze our business. Let's look at the kind of accounting methods we are using. Okay, and then let's now decide on the best method to use. I'll urge everyone, even though we might be small companies, I'll urge us to use the accrual method. Let's recognize revenue when we earn it, and not let's recognize revenue when cash is used. So tomorrow, God willing, I'll be sending in our second assignment. But please, let's do well to submit the assignment I gave on Tuesday. Yes, wasn't yes on Tuesday. Let's do our best to submit. Okay, so Abdullah has a question. Abdullah, do you have a question?
Yes, please.
Okay, please, I'm
Okay.
listening.
My question is, let's
Mhm.
assume I'm using the accrual method of accounting, and
Okay.
then make an order for a product or a part, and then I record it.
Mm-hmm.
However, things happened and I couldn't get the things I ordered. I couldn't also get a refund. So in that case, would I go back and make some changes?
Yes, so I know that we have something we call in accounting bad debt. So let's say with what you are saying, let's say you made an arrangement to receive some goods. Okay, the goods you're receiving, is if the ones you're going to use or you are giving to your clients? I want to
Is the
understand your
one?
question very.
It's like I'm making an order for in my inventory.
Okay. For inventory, okay. So you go and record it. All right. So as you have recorded it, if there are any changes, because for the accrual, it goes on. Okay. So because maybe for one or two reasons you couldn't get it anymore, it will affect the transactions at the end of, maybe in January you made the order, okay, but then in February that, okay, so this order cannot take place anymore. The transaction will have to be, you have to cancel the transactions or after the transactions because I'm going to receive money for it, but then you need to record it, or you still don't understand.
I get it.
Okay. I also want to understand your question very well. So it's an inventory, right? You're receiving goods, right, from
Yes,
your client.
yes, and
And you're going to pay and you will
I have
pay him, right?
I've already paid for it.
You've already paid for it, but he
Yes.
couldn't supply it.
Yes, and I didn't also get a refund.
Okay, so I mean that will be classified as a bad debt. There's something accounting called bad debt. It means that people owe you, but one way or the other, they couldn't pay, and then they are canceling that. So that becomes a bad debt. Okay, so there will be a bad debt account, and you're going to debit your bad debt account. You're going to credit your receivables. So let's say because that particular supplier was a receivable, you've paid him, right? Oh, okay, you've already made a payment. So it's going to be a bad debt. It's going to be a bad debt because you didn't receive it and you're also not getting your money. Ideally, you should get your money back, but because you're not getting your money back, it will be a bad debt.
So what
You understand? So there will be an account.
if I were to
I'm
get
listening.
my money back? What would be how would I do the changes? Would I
Okay.
also report that one as money received?
Yes. So you are going. So you're going to debit your cash and you credit the goods. Do you understand? Because a transaction has occurred. Because you were supposed to get goods from him, you didn't get it, but he gave you your money back. And as you receive money, you have debited money. You've received money into your account, so you're going to debit. Sorry, your cash account. Initially you credited your cash account, right?
Yes.
Initially,
Yeah.
let's check it one after the other. So your supplier's account, let's say he's called supplier A and your account. Now you credit your account, okay, and you debit this is the case, you didn't receive the goods anymore. Okay.
Yes.
So now you have to go and reverse the transaction. You made this transaction, but in February you're not getting it, but he gives your money back to you. So you now go back to your cash account. Now you debit it that you receive the money, and now you go to the goods account, that particular goods, so that's a particular supplier. Then you credit his account, so it cancels each other. Do you understand?
Yes, please.
So it cancels each other. Every day it's cancelled. So when you are closing your ledger account, you see the balance. It will be cancelled out with the supplier because you received your money. But if you didn't receive your money, then it becomes a bad debt.
Okay. Okay.
Yeah, that's it. Please, any more questions? If there are no more questions, it means that today we are done with today's class. And as I always say, I'll urge all of us all to be very consistent, because if you really want to learn and then improve upon our business, we have to be consistent with the class. And also, it's important that at the end of the day, at the end of every course, you get a certificate, okay, and it might help you. So if you're not consistent with the class, and at the end of the day, we are compiling all the attendances, and you were not consistent, it might affect your certification. So please, let's do well to make time for the class. It might be difficult for you sometimes the time, but then let's do well to make time for the class. And please, if there are any questions, I'm available. You can reach out to me anytime, okay, and then I'll help you out. Let's not forget our assignments. Based on our assignments, sometimes I can even give some feedbacks. After the assignment, I'll give feedbacks to everyone. It will be individual, okay. So probably you might not have prepared the things very well, the things I'm asking. So if you do the assignment, I want to know where I can help you. All right. So let's have a wonderful day, and then see you tomorrow, God willing, at 10. Because the internet was smooth, we will still have the class at 10 to 11. Is that all
Okay.
right?
Okay.
Okay. So we are ended for today. Thank you very much for making it a point to come to the class. See you tomorrow. Have a
Thank you too
nice
for
day.
teaching it in simple form.
Okay, you are all welcome. All right. Bye.
Bye.
Bye.